Hello and welcome to CISI TV. On Friday, 20th of January, the day that President Trump was inaugurated in the United States, we were delighted and honoured to have with us a brilliant speaker. Efram's responsible at Nasdaq for product development, research and content creation. And during his tenure there, he's launched thousands of indices, resulting in innovative benchmarks and index tracking products. Some of his notable launches have been Nasdaq's US All Market family, the Global Equity family, and of course the Nasdaq Commodity Index family. It was great to hear Efram kicking off our 2017 Capital Challenge, and we look forward to welcoming him back in Britain as soon as possible and enjoy and learn from this terrific talk by him. Thank you.
Good morning. Thank you all for having me. Thank you to George and CISI holding this event, and excited to be here with WisdomTree and Elixir as well, our ETF partners. So it's a tough act to follow, hearing that Dave, my boss, did such a good job last year, but he's reviewed my presentation, so hopefully he agrees with some of my predictions for this year. So we're going to be talking a lot about commodities in today's presentation. Before I want to jump into that, I'm just going to give a broad overview of Nasdaq's index business, how we've grown over the last 40 years or so. Back in 1971, Nasdaq's index business began with the launch of the Nasdaq Composite. It's an index comprised of all Nasdaq listed equities in the U.S. on the Nasdaq exchange. Fast forward 15 years, we launched the Nasdaq 100, a tradable version of the composite, the 100 largest non-financial companies listed on Nasdaq. I'm actually going to get into that at the end. I'm going to cover briefly on the Nasdaq 100 as well. Fast forward 14 years. Beginning of the ETF work from the index perspective, with Nasdaq we launched PowerShares, which is now known as the PowerShares QQQ. Nasdaq actually was the original sponsor of the product at the time. So it was Nasdaq was actually the sponsor, and we since transitioned that over to PowerShares in 2007. Moving forward, you can see over the course of 2007 to 2016, we acquired a number of exchanges, launched a number of index families ranging from equities globally to commodities, which I'm going to talk about today, green economy, and of course Dorsey Wright and associates. I'm going to cover that as well, their relative strength momentum methodology. Back in 1999, the QQQ ETF, Nasdaq 100 largest ETF in the world, launched. Today, January 2017, we have just under 300 ETFs, or ETPs, tied to our index business globally, with about $124 to $125 billion in assets. Going from one product to now with just under 300, we're listed in 19 countries on 23 exchanges with 43 different providers worldwide. We have hundreds of products outside of ETFs as well, UITs, mutual funds, derivatives, in actually 28 countries, so structured products. So outside of ETFs, we also have a very large number of products worldwide tied to our business. Getting to the highlights of today's presentation. Oil capacity or supply experienced revolutionary shift in the past few years. U.S. supply exploded. The Middle East continued its pumping, and global demand was stifled, resulting in a shift that started about 2 years ago, and that's continued. Fundamentals within the U.S. continued to improve, while other markets still face headwinds. The U.S. once again outperformed the global markets. And looking at the Nasdaq Global Equity Index family, since the financial crisis receded, our U.S. benchmark index outgained the world by approximately 140%, and once again in 2016 by around 8%. So today's the agenda of my presentation today. We'll talk about some industry trends. I'm going to talk about the 2016 Commodity Index Family Review and what changes happened and why those occurred. I'm going to cover a little bit about a study that we did on our research team about different contract roles and the timing of the role and why potential performance gains can be achieved. Talking about Dorsey Wright and the relative strength momentum methodology, and then wrap up with the Nasdaq 100 and briefly on smart beta. So oil, a case of supply and demand. Oil, specifically from the U.S. fracking revolution, is truly monumental event for the modern world. Given especially the results of the U.S. presidential election, most people think about it's not really a matter of if anymore whether or not the U.S. can become or will become energy independent. It's more a matter of when. Really the seismic shift, you could say, from 2012 to 2014, around $100 a barrel being a norm for crude oil, to $50. Really a larger concern, more traditional markets where the whole economies like Canada and Venezuela, Saudi Arabia, and the like, dependent entirely upon price. And of course, the U.S.'s ability to begin exporting LNG and oil in the near future should result in a fundamental shift in this global policy. So over the next few slides, I'm going to have a couple different charts. So I'm going to start out by explaining those charts, and then I'm going to kind of get into some of the highlights there. So on the left, we have the chart back to 1920, showing the U.S. field production of crude oil. And on the right, it's breaking out specific formations, with Texas, North Dakota, and Alaska. So what the chart actually is in, so it says thousands of barrels per day, but it's actually in thousands. So it's actually 50 million is the bottom over here, up to 350 million, right? So you can see back to 1920, we had about 50 million or so barrels per day were being produced. That resulted in the largest actual production occurring in the mid-60s. And of course, dropped off quite a bit and changing in U.S. policy. That's since really exploded with the fracking and shale formations. And then that started to taper off and drop down. And you can see the very high correlation between the entire U.S. growth and somewhat drop off to Texas on the right-hand chart, as well as North Dakota, but not really as much so, right? Global supply is steadily increasing. So you can see here on the left chart, this is the world oil supply, and on the right, it actually has the largest contributing countries. So I personally going into this research, and before I saw Dave's presentation as well from last year, I knew the U.S. was relatively close to the front personally, but I didn't realize that we ever actually outpaced Saudi Arabia. So that, for me, that was really interesting. Of course, Russia's really high on that list, but you can see back from the 90s, going from 65 million to about 95 million barrels. It's really interesting seeing that data played out here. Another impact, on the oil prices is going to have a lot to do with GDP, and especially specific emerging market countries like China and Brazil. You can see over the last few quarters, or really more than a few quarters, back to about 2009 with the financial crisis in the U.S., the GDP in China as well as Brazil has essentially been quarterly, from a quarterly perspective, been going down in a repeated fashion. As a result of that, the slowing consumer demand really is spilling over into the oil markets, contributed a lot to falling prices, and why we went from the $100 a barrel to around the $50 a barrel. Having said that, part of what I'll be discussing in the next section and the next few slides is, while that might be the case, there's reasons pointing to oil actually making a strong rebound. China's actually forecasting a 3.5% forecasted growth in demand over this year from research that our energy advisory services team at Nasdaq pulled together recently. This slide covers the world production as well as world consumption. So on the left-hand chart over here, from 2012 and so on a quarterly basis through the end of 2007, the end of 2016, and then actually has forecasted projections. The blue line over here, that actually showing production, and the black line showing consumption. So if you look at it, comparing, right, and why there's a gap over here, and comparing that to the price in oil, right? So over here, you can see it's highly correlated, right? From an economic, fundamental economic perspective, when supply and demand are getting out of whack, naturally there's going to be a change of drastic supply change in price due to that oversupply, and as a result, $100 to $50, right? It's very, very economically driven. But as that has tightened over the last quarter or so, you can see that we're actually starting to see an increase back in the price of oil, and that really makes fundamental sense from an economic perspective, going from hitting about the lows of about $25 in the beginning of this past year to coming already back up to the mid 50s. Again, very economically driven. So And I actually want to start with my last bullet point. Since the U.S. presidential election, and really with Trump coming into office today, call it the Trump effect, right? That's really been seen quite strongly in oil, with oil coming up in prices about $10 a barrel. Very large increase just over the last 2 months from a return perspective. The slowdowns, like I mentioned, in China and Brazil, that definitely impacted oil markets, but again, given the most recent forecasts for China, that should certainly help the prices moving forward. U.S. being the largest contributor to increased oil supply, that trend is continuing as well from, again, research that the energy advisory team at Nasdaq mentioned very recently. And being at the $50 level really is seen kind of from a relative strength perspective as you can almost say like a bottoming out. So over the next few slides, I'm going to talk about Nasdaq Commodity Index Family, the annual review, and what changes transpired and what commodities actually performed the best from our family over the last year. So our Nasdaq Commodity Index Family, which I helped launch with Dave, which is about just under 500 indexes, it's based entirely on U.S. dollar denominated futures listed in both the U.S. and London. Today there are 32 different commodities, futures-based commodities within the index. They're set up with 5 different roll variants. So most people know when they think about commodity futures, they think of the front month, right? Really the next month, the next contract to expire. So we have that roll variant. We also have 2 different roll variations. We have a second front, which is the second month, right? You're always rolling. The third front, which again, you're always rolling to the third every month. Then we have 2 different ones. One's called the second hold. We're always going to buy the second one on the curve, but actually hold it for the 2 months until it expires. Or the third hold, we're going to buy 3 months out and then hold it till it expires. It's, again, very vanilla, but actually pretty different. No one else really offers that to our knowledge. The index family covers broad main sector indexes. We have diversified, but the products that WisdomTree actually covers that track the 28 products that WisdomTree Europe tracks are actually on the single commodity front month contract indexes only. There are about 7 of them, crude oil, gold, and palladium, and others. The rebound in energy was really the major story, but generally speaking, outside of the livestock index, majority of commodities actually had a very strong year in 2016, with our benchmark being up just under 14%. Energy being the highest performing industry sector index, having 18.4%, very closely followed by our industrial metals index, which is mainly comprised of the LME industrial metals, but also includes high-grade copper at 18.3%, and precious metals 8.5%, and agriculture, and then followed by livestock. This gives you a performance breakdown from top to bottom, this chart now here, from the best performing to the worst performing individual commodities. So it might be hard for some of you to see in the back, but zinc was the best performing and cocoa was the worst performing. You can see Brent crude and crude towards the top as well. From a rebalance summary perspective, like happens every year in the first 5 trading days in January, as a result of the review that occurred, there are changes in target weights to our benchmark. Energy had a slight reduction, same with industrial metals. Precious metals had an increase, as well as agriculture. This is for kind of get more into the meat of a study that we're talking about that I mentioned earlier, that our research team performed on the contract roll side. So I was saying earlier that we have 5 different roll variations within our index family, but one of the things that's actually differentiates our index family is when our commodity contracts roll within our methodology. We actually roll the first 5 trading days of every month. S&P GSCI and Bloomberg roll the 5th through the 9th trading days. Interestingly enough, when really depending upon what kind of market environment you're in, that can actually translate into, despite only a few days difference, a relatively significant increase in performance or difference in performance depending upon market environments. Again, what kind of contango environment you're in and when you're going to be buying your contract can actually have an increased impact on returns. So here on this chart, the blue line is the Nasdaq index, commodity crude oil. The orange is Bloomberg, and the green is the S&P GSCI. This is a quick chart over the year ending essentially the first week of November. And I'm going to show you this chart. I'm going to kind of go back and forth on the next slide, showing quarterly performance differences between Nasdaq and Bloomberg, as well as Nasdaq and S&P. So blue is the Nasdaq versus Bloomberg, and orange is Nasdaq versus S&P. And you can see on a quarterly basis from the Q2 2015 forward, relatively consistent, right, persistence of Nasdaq outperforming Bloomberg, again, which was formerly the Dow Jones UBS Commodity Index. And orange, actually relatively consistently against the S&P, we've continued to outperform. Now, looking now at this chart over here, this is the spread of the third contract in crude versus the front month, right? And when you compare the two, actually, it's really interesting, right? And again, I'm going to go back. Sorry, I'm going to go back and forth a little bit so you can see really the very highly correlated data differences here, right? The peaks and the troughs, and a lot of this has to do, and it's showing how when you're doing your role and what kind of market environment you're in really is going to impact it. So if you're going to be buying today a contract that's farther out on the curve, that's more expensive, the quicker that you're going to be able to buy into that contract, the more likely you are to actually get a better price, right? And that's going to lead to higher returns. I'm going to cover in the next few slides Dorsey Wright. I'm not sure if any of you in the audience have heard of it. Nasdaq acquired Dorsey Wright and Associates back in January of 2015, so 2 years ago this month. Originally was founded in 1987 by Tom Dorsey. It's essentially a fundamentally driven, rules-based, transparent methodology into momentum, entirely based upon relative strength, utilizing the point and figure charting methodology. Today, they're roughly about $14–15 billion in ETPs tied to the Dorsey Wright methodology specifically within our index business. The next two slides, I'm going to talk about Dolly, which is a certain portion of Dorsey Wright. It's called dynamic asset level investing. It's a rules-based, transparent approach into asset allocation, right? It's a top-down look at really asset classes, and you're ranking them utilizing relative strength. And so we have domestic equities, international equities, commodities, fixed income, cash, and currencies. Every one of these asset classes utilizes all US listed ETFs, and they compare them against one another, right, from a relative strength perspective. So here what this is saying is domestic equities is actually from a relative strength perspective the best asset class to be in, and currencies is the worst asset class to be in today. Now, this methodology has actually been in existence with Dorsey Wright and been run for just under 15 years. So while the ETF world has come into its own, this methodology and ranking system has clearly been able to get more and more data and really become more and more, really a stronger signal as the industry has evolved. Utilizing the Dorsey Wright website and getting into the Dolly ranking system, when you click on any one of the specific buckets, you can break down further into where the relative strength and asset class dispersion is coming in a more granular perspective. So in commodities, for example, industrial metals is where you want to be, and agriculture is actually where you don't necessarily want to be. Energy is actually second on that list. Part of Dorsey Wright's offering, they have a matrix ranking system, which is, from a relative strength perspective, it's determining which is the best commodity to own. So this is the list of 25 commodities. And so crude oil is on the top of that list. Cocoa is on the bottom. When you think about where the performance was laying at the end of 2016, not really surprising to see that. Want to show really just what the point and figure technical analysis charts look like, and of course, you can talk to me afterwards, and I can get you set up with the demo or with folks on our team if you have any further questions. On the left and the right side, it's just the price over the next few slides of the actual commodity that we're looking at. O's are indicative of the price falling. X's are indicative of the price rising. If you have 3 X's or more in a column, that means that it's a buy signal. If you have 3 O's in a column, that turns into a sell signal. Excuse me. And what's interesting, and something before we'd acquired Dorsey, right? I didn't realize this. I always thought about things in terms of dates and times, right? That's, people have asked me this as well. And when you look at momentum, how do you guys look at it? Do you look over a different time horizon? I said, well, from a Dorsey Wright perspective, it's time agnostic. That's why there are no times on here. Sometimes the relative strength chart, it can actually be decades. We can look at it, sure, from days or even intraday, but this can be decades, or it can be months, or it can be a year. And that was, I didn't point this out, but this was the crude oil, and you can actually see that we're in a bullish trend. And right now the buy signal targets $68. Getting back to cocoa, it's been on a bearish trend for quite a while, and that has continued to persist. HG copper, which is also towards the top of the matrix system, that's actually in a buy signal. So it was on, for the most part, you could say it was on a bearish signal, but set some healthy consolidation. You can see up here, and as a result, that's resulted in a buy signal and a bullish trend today. And that was a chart on similarly on the U.S. dollar. Wrapping up the Dorsey Wright section of the presentation. So very recently, we launched an index based upon commodity futures that looks specifically from a relative strength perspective and selects the five best from a relative strength performing commodities of a list of 20 that go into one specific basket. That's rebalanced on a monthly basis to be equal weight. So again, you're getting to get the best of breed commodities on a monthly basis in that methodology. I conclude now with wrapping up on Nasdaq 100 and then smart beta. As I stated in the beginning of the presentation, Nasdaq 100 includes the 100 largest non-financial companies listed on Nasdaq. When we here at Nasdaq think about Nasdaq 100, the two words that stand out the most, and kind of say these over and over again, are innovation and disruption. Right? It can be Apple, it can be Google, Amgen, Starbucks, Tesla. These are just a handful of the names, right? They're really changing the way consumers and people really live their lives and how they move forward, right? In their daily routines, right? Technologies, not just cell phones or computers. It's a better car. It's a more efficient car, right? It's changing the way you think about getting a cup of coffee. You're not going to go out and quickly spend a pound or two on a cup of coffee and run out necessarily. Today you might actually go in and sit down and read a book, bring a friend along and talk for a little while, right? That's a monumental shift in the way people used to think about having a cup of coffee. Now it's okay to spend 2 times the price because I'm going to be hanging out with some friends or reading or what have you. Over the last 15 years, the Nasdaq 100 really has come into its own from an earnings perspective, and you can really see that not just from a performance side, but thinking about where the index was 15, 20 years ago and where it is today. So we actually just crossed the 5,000 level recently. Last time it was there was in the tech bubble. From an PE perspective, of course, right in the tech bubble, with the majority of the index, it's about 50 to 60% for the most part technology based over the last 20 years. The tech bubble, naturally PEs were extremely high. Today they've really stabled out, and over the last 15 years you can tell earnings have really risen. Dividends have been paid out, have increased in a dramatic fashion. Shares have been bought back, and again, companies have continued to innovate, disrupt, and really come into their own. And you can see since 2003, a compound annual growth rate of some of those figures. So earnings has been up 25%, revenues 14%, dividend value 32%, and PEs contracted 14%. From a dividend yield perspective, right? So most of the companies we're talking about are highly weighted to technology. The dividend yield was actually almost zero back, about 2003, about 10 basis points. Today it's about 130 bips. Companies like Apple that started paying dividends 5 years ago. Companies like Microsoft continuing to pay and increase, and other companies coming along as well. Dave really likes this slide, and I kind of do too. It's kind of a play on active management. But if you look at the Nasdaq 100 compared to the S&P 500 and the MSCI World Index, since 2008, every year, other than actually this past year, we've outperformed both. Of course, the best of active managers can't outperform every single year, so I have to caveat that. But index is quite strong, and from a cumulative basis, really outperformed in a big way over the last 16 years, back to the beginning of 2002. Sorry, beginning of 2001. Smart beta, and then I'm going to wrap up and go into questions. Today, we actually, just over 40% of the ETPs tied to our index family are in smart beta. So we're a very big proponent of smart beta, doing everything we can in the space. Very interested in pushing that part of our business forward. When we think about smart beta, really think about taking alpha that used to be generated only by active managers and turning into a rules-based, transparent methodology into an index passive fashion. It really can be accessed at a far lower cost to investors. As a result as well, there's no real bias there, right? It's going to be rules-based and transparent, whereas active management, there might have been a bias to hold something. We've been a leader in smart beta push. Today, again, like I said, we have just about 40% of our assets tied to our indexes, which is roughly about 55 billion or so. Today, the ETFs in the smart beta realm translate to about 500 billion or so. So we're just over 10% of that footprint. You can't not show some data now, of course, when you say something like that. So we have in the US as well as European performance metrics. And when we think about smart beta or really just any aspect of the market, you don't necessarily want to think just in a short-sighted fashion, a year-over-year basis. You really want to look at a much longer time horizon and frankly think about what kind of market environment you're in. So on the top, we have some of the US indexes. We have the US Broad Benchmark Index, with the US Large Cap Alphadex, US Capital Strength, US Buyback, and US Dividend Achievers. And these are all price return indexes. They're not inclusive of total return. So while the Dividend Achievers has underperformed, it's actually, of course, at a higher yield than our Broad Benchmark. And you can see from the 1, 3, and 5, and 7-year horizons, depending upon which index, you'll see the differences in performance. And by and large, the majority have greatly outperformed over the entirety of the horizon. One miscue I realized in the chart I mislabeled. These are actually flip-flopped. The data is right, but this is Germany Alphadex, and this is the Nasdaq Germany. This is the European Alphadex. This is the Nasdaq Europe Benchmark. This is the Germany Alphadex and Germany Benchmark. And you can see actually really the outperformance there as well. Because with that, I'll open it up to the floor to questions.
Great, thank you, Efram. Great, thank you. We're going at a rattling pace here. Brian, first question.
From just going right back to the beginning of the oil production.
Can I just get this microphone? Thanks.
And the fact that the US is now top of the oil producers league, the sustainability of that in terms of reserves. I mean, clearly, fracking has seen a huge increase. How does what are the projections on that? That is, taking the empirical view in the last few years. How sustainable is that?
I mean, given I would say, given that we now have Trump coming into office, I imagine that will continue. I haven't seen data, but though in truly too far in the forecast perspective. But like I was reading also on some of our energy advisory team, we still hit an all-time high just this past week in the U.S. production. So that hasn't slowed down, and that was with Obama in office. So again, I don't anticipate changes there, but a great question.
Thank you.
Thanks.
The Dorsey Wright Index series, is there any products that are available with that in Europe or the UK so far, or
From an ETF?
ETF perspective? Yeah.
Not to my knowledge, though we're working very hard and trying to bring those products to market here. We're also trying to talking with sponsors, right, and trying to get that. So that's really was predominantly a U.S.-centric approach. That's where they were based, a very small team. But we've really taken it, much more broadly and starting to go international. We finally have now some products in Canada. We're starting to build that momentum, and with Barris, sales guy here in our audience as well, we're talking to some clients and trying to push that forward. But then again, if anyone has any questions on Dorsey Wright, please don't hesitate to ask. And we can definitely set you up with a demo and have to talk to some folks on our team.
Thank you.